So, what's going on with startup valuations anyway? There are big changes underway, and anybody who's been investing for 5 years or more has seen dramatic changes in startup valuations. And what I mean by this is the average price paid for an equity investment in a startup has gone up by several 100% since 2010. Just in the last year, the price of an average startup has gone up by over 50%. So, what were the factors that would lead to such a dramatic increase in valuation? And by the way, I'm not talking about the companies who were invested in last year and now they've increased by 50%. I'm talking about new companies coming in who have never received investment and pre-revenue or whatever, all at the same stage. So these startup companies, the valuations have gone up dramatically. So I found 5 things to account for this rapid increase in valuations. And the first is the Shark Tank phenomenon. 6 million people every week are watching Shark Tank on ABC, and they're thinking, hey, that's cool. I want to be a shark. I want to get involved with that. But if you learn how to be an angel investor by watching Shark Tank, you're probably not going to be a very good angel investor. Amateurs who watch Shark Tank are going to have bad models for how to structure a deal or how to value a company. And maybe you have no way of knowing the difference between a $5 million company or a $10 million company, and you just want to get involved and you write checks at any price. Shark Tank investors really don't have a good set of tools, and they don't have a way to set the right kind of price. The second factor is the accelerator phenomenon. Since 2006, when Y Combinator and then Techstars came onto the scene with the accelerator model, it's been a great thing for startups. They've hundreds of accelerators now exist, and these accelerators are helping startups to move along quickly. But if you look at the model of accelerators, it's basically a venture capital model. It's backed by limited partners who are investing in these companies, and it behooves them to have the highest possible valuation at demo day afterwards. There's 2 reasons for this. One, of course, it enhances the prestige of the accelerator if they can say that their average valuation is much higher. And 2, the limited partners in the venture funds that support the accelerators get huge paper profits if they get these large valuations. The third factor for increasing valuations is the convertible debt phenomenon. So, convertible debt shouldn't really impact valuations in any way, except that it does, and primarily because of a misunderstanding of both investors and entrepreneurs about how valuations work in convertible debt. Now, some of the first convertible debt deals were straight convertible debt, where it was a 20% discount and maybe a 6 or 8% interest rate. In the most recent years, we've seen a valuation cap put onto convertible debt deals because people found that it was unfair to have a company doubling and tripling in value and only getting a 20% discount when that converted into equity. So these valuation caps should be exactly equal to what the equity valuation would be today in a company if we were doing an equity deal. But a lot of entrepreneurs and angels get confused about this, and they think, oh, if the deal is going to convert in a year or 2 even, then I should make the valuation whatever the valuation will be in 2 years. And for that reason, both angels and entrepreneurs are setting valuations way higher than they should be. It really makes no sense that an angel should make an investment early on when risk is high and then have to pay tomorrow's lower risk price, especially when that lower risk came at the risk of their money making that happen. The fourth answer is unicorn phenomenon. I've seen so many companies who are coming in with high valuations and they're saying, well, we're going to be the next Uber of this, or Airbnb of that, or Pinterest of something else. And people are pointing to these 140, 150 some unicorns now, which are $1 billion or greater private companies, usually former startups, and they're saying, I'm going to be one of those, so I am justifying a $10 million valuation for my pre-revenue company. So some people are falling for that. There's sort of a greedy factor, and the unicorns are all in the news, but it turns out most companies are not having that kind of a phenomenon, and it does not make sense to use unicorns as your comps for your valuation. So for future valuations, the pathway for angels to make smart investments and for entrepreneurs to do fair deals is for angels to invest in groups. And when people invest in groups, you get a lot more expertise, you get a lot more thought that goes into the investment, and larger groups like the Angel Capital Association, which is made up of hundreds of angel groups, have great guidelines and classes that they can use to teach angel investors to do better and more rational deals. Valuations for Angel Capital Association companies are running 25 to 50% lower than some of those things that are happening on the coasts or from accelerator programs. So smart angels who are not with accelerators or amateurs who invest in groups, they'll be the ones to have reasonable valuations.